All right, good afternoon. Check, check, radio check. I want to welcome everybody for being on the call today. Chris Lester here. I'm going to be your speaker. For those of you that don't know, I am a financial advisor. I've been hosting these calls for a little over a year now, and they've seemed to gather a following. So, with COVID seemingly in the rear view mirror, that's great news. I think people are looking to get back to a semblance of normalcy. But New Jersey's still a little bit under tight reins. And so, I continue to want to stay in front of my clients. We have advisors that are on the call. We're part of a nationwide network of advisors that are like-minded. And the whole point and purpose is to help on a weekly basis, to help bring valuable content on things that, maybe you've heard about finances, maybe that affect you, or maybe you've seen something on TV or heard something. So sit back, relax. The whole point is if I can give you valuable information that you'll make good decisions on a go-forward basis. So the reason I named this, I hate life insurance. Here in New Jersey, back a couple of years ago, there's a diamond distributor in this area, David Singer. I hate David Singer, and you should too. And it's like, because, if you go into David Singer's jewelry store, you're buying a diamond, right? So I just thought it was a neat play on words. But life insurance is a really, really valuable tool. And what we're going to talk about today is why you should hate life insurance. And if we're going to hate something, let's understand why it is. And the reason is because typically it's designed by actuaries and attorneys. When you use those two words in the same sentence, chances are it's confusing. And if you've ever sat down with an insurance salesperson, that's all that they do, you may walk out of that meeting and you might be looking at the paperwork sort of something like this. Now, I love this picture because it just says it all. I normally will use the reference deer in the headlight, but I just think, what the heck are they talking about? Why you shouldn't hate life insurance is because you don't have to die to use it. This is not your grandparents' great-grandparents' life insurance. Products have evolved, things have changed, and there's a lot of benefits that you can actually gain and use using sections of the tax code that make this, in my opinion, one of the single greatest gifts that Congress has ever given the American taxpayer. You have living benefits. What does that mean? Meaning that while you're alive, if something should happen, that you can actually access benefits of the policy to utilize while you're alive. I think that's important. It gives you leverage to be able to access money for life's needs. Long-term care, hybrids. This is actually one of the areas that a lot of people, come to me and say, hey, I need long-term care, but it's too expensive. This can be another way to slay the dragon. People hate long-term care because I just had a doctor reach out to me this week. He's like, Chris, I was presented through our association long-term care, and it's so expensive. There's other ways to gain this benefit, but it has to be taken into consideration because, no tool can typically do all things. So that's why, part of sitting down with a professional is understanding, hey, first we're going to sit back and understand what your goals are. What are you trying to accomplish? And then we can put structures into place to help you to meet those needs. Acceleration of benefits. So one of my partners had a client that passed away 3 years ago, but a year before they passed away, he had put a $2 million whole life policy on this gentleman. And one of the features of that is 75% of that death benefit was accessible while he was diagnosed terminally ill. And so being able to access that type of money before you pass away to either pay for medical bills or to spend time with the family, quality of life, is just comforting. Now, one of the areas that you're going to see that we talk about quite often is tax-free income. So as we start to look at, I've spoken over the last couple of weeks, different strategies. Last week was Kaizen. And in the past, I've talked about Roth IRA conversions and alternatives. Properly structured cash value life insurance can be like a giant or a super Roth IRA vehicle. And then waiver of premium. I mean, these contracts, a lot of carriers will, if you start off putting a large amount of money in, allow you to, if something were to happen, they will continue to fund that even if you become unable to work or you have a qualifying disability. That's really something important to think about because your 401ks can't do that, right? Your IRAs can't do that. So again, if that's important to you, it's a feature that we can look at. What I try and do is keep things simple. When it comes to life insurance, people get so confused. You hear the radio commercials. Everybody makes this seem like it's such a cheap commodity that you don't have to worry about. It's so expensive. You're paying too much. And listen, one of the things I've learned in my career in the insurance industry is that there are no deals in insurance. There's some way, shape, or form that the insurance companies are making money. You just have to understand the terms. Remember, they were written by actuaries and attorneys. So think of it like this. Life insurance, I typically would, draw a flight of stairs on a whiteboard in my office. And the first stair is 1 year. And then the last stair, obviously 100 stairs up is age 100. Typically, when we look at term insurance, right, every year that you go up in age, the closer you are statistically and probability wise will reach age 100, the closer you are or the higher probability to death. Therefore, they charge more per thousand in order to do that. Now, since the 1958 CSO tables, that's Commissioner and Standard and Ordinary tables, they've since lowered those ratings. Back in 1980, they lowered them, then again in 2000, then again in 2010, and they've been lowered again. What that means is people are living longer. And people are living longer, and they're still buying products that are 10-year term, 20-year term, 30-year term. Insurance companies, basically the way you think about this is when you buy term insurance, right, is you are basically making a bet that you are going to die in that time frame, right? So if you're 50 years old and you buy 20-year term, you're saying that I'm going to die between now and 70. And there was this old thought process that, hey, after you reach retirement, you don't need insurance anymore. And again, I was taught that early on in my career. I have since found out that that is a huge mistake for most families. Okay. Now, most people don't have a problem with insurance, life insurance, or any insurance for that matter. What they do is finding the money to pay for it. And that's why people look at it, if you look at what is the cost of insurance, well, for group term or term, think of it like renting, right? If you've ever rented an apartment or rented anything, at the end of it, you got the right and the privilege to use it for a period of time. But at the end of that period of time, you get nothing after that, right? That's why, group term insurance is quite often one of the most misunderstood products that people have in their overall financial plan, because they go, oh, well, I have it through work. Okay. You don't own it. When they do these group term insurance, yes, it's some of the least expensive insurance you can buy in the marketplace. And as long as you're an employee of that corporation, you can keep it. But as soon as you leave, now you're going to step into the arena of, they won't cancel you. They'll give you the option to buy it at your current age based on whatever product they still have on the shelf at whatever cost at that point in time they feel is they need to do to meet actuarial data. So be careful thinking that you're insured. Hey, listen, you got 5 times salary, you're making $100 grand a year, you got $500,000 and you're paying $1,000 a year for it. Bravo, right? But that should not be the only source of life insurance, in my opinion, and most people that I've seen or worked with, that should not be. The other types of insurance are what I call permanent insurance. Ownership. You actually own policies. So whether it's whole life, variable life, universal life, or index universal life, a lot of different designs, but they all basically build equity, just like a home. The only one of these types of insurance I do not like, variable life insurance. I cannot think of a variable product that I typically like because it's too subjective. Typically, they're loaded with fees. There's a high amount of risk. Most people don't understand it, and they end up purchasing something. It wasn't designed correctly in the first place with this hope that they would get rich overnight, and it's typically not how it works out. So of the rest of these insurance, at least you have coverage, right? So we're going to talk a little bit more. Whole life, there's a place for it. I typically will use whole life if somebody needs absolute guarantees for, say, estate planning. But when we start to look at wealth accumulation or tax-free income, I start to move into the direction of index universal life. So if home ownership makes sense, and we all typically know, hey, listen, I don't want to throw my money out the window renting a house or an apartment. I want to buy a home. Well, if that makes sense, so should life insurance ownership. It's the same concept, and the equity that ultimately gets built in is for you to use for you and your family's future. So these two sections of the code, again, are what I feel are the most important sections of the IRS code, of which there's 70,000 plus pages. It's these two sections that say that the most unique feature of permanent life insurance of these two codes is the accumulation of cash inside the insurance contract. It's tax advantage. Not only can the cash value accumulate tax-free, but the cash can be then also accessed tax-free. Hence the beauty and magic of life insurance. It's a unique vehicle that allows tax-free value accumulation and then allows you to access your money tax-free, and when you die, blossoms in value and transfers income tax-free. This is why when I'm dealing with clients and we start to put this in place, what I start to help you to understand and view life insurance as, if I remove the word life insurance and just replace it with the word asset class, when it's properly structured, can be a very, very important part of a person's portfolio. I've been doing this for, I'm 30 years in the business, and I've helped families protect them, their families, their spouses, and then do legacy planning along the way. Very, very powerful tool. This, if you want some light reading, you can go on Amazon and pick up this book. This book is about $150. I've had some people pick this book up. It is not for the faint of heart. This is actuarial data, but it helps you to understand in its most basic fundamental terms how cash value life insurance has been created, how it's been tested, the rules that are around it, and how to stay within what we call guidelines. I'm going to take us through a Reader's Digest version of this so that you get the gist. But if you're looking for some light reading or you want to educate yourself, feel free to grab this book. It does help shed some light on the validity of the IRS tax code and how long it's been around. All right, so this is what I call a 10-minute lesson on life insurance. Not going to take me 10 minutes. I see if I can get it done in 3. With all life insurance, there's a minimum amount of premium. And in this example, let's say it was $500,000 that could be charged. And then there's a maximum amount of premium that can be collected. The IRS says, based on that book that I just showed you previously. The person that determines the minimum amount of premium that they need is the insurance company. The person that determines the maximum amount of money that you can put into a contract is the government. The fact that the government is even remotely concerned with how much cash you can put inside of a cash value life insurance policy should tell you one thing as it relates to taxes, and that's that it's good. So, basically, it has infinite product designs, can be designed a couple different ways. But let's say that the internal cost on a max funded policy was $1,000 in this example. But the IRS said that you could put 10 grand in. The $9,000 that goes in there is your money that is growing, compounding, and then ultimately will be accessible, all the growth of that money to you tax-free. And when properly structured over time, it's like what I always say, it's like we're baking a cake. You don't want to put this in 1 year and turn around, take it out and go, oh, the cake's not done, right? We'd open the oven, put our finger in the middle of the cake. I used to get my hands smacked all the time for doing that. And it would come back and it wasn't done. But when you leave it in there for the adequate amount of time, right? This is one of the last assets that I have clients touch, just so that we can start to solve this other problem, which are RMDs with their 401ks, or IRAs, all the things the puzzles that most people struggle with. How do we lower the amount of taxation we pay because of Social Security? The money that comes in from cash value, properly structured cash value life insurance can be tax-free. And what's really cool about it is it's not subject to provisional income, like say muni bonds or things like that. So your Social Security isn't taxed. There's a lot of advantage when properly done. These are all the benefits that you can get. The one that's now at the bottom here that you can't get, I mentioned the other day when I was doing Kaizen, and this is why I went over this, because Kaizen uses this strategy, but then it's going to borrow money on top of it. But remember what I said last week is that we cannot take it as a tax deduction and expect all these benefits to come to us tax-free. So the powerful advantage of locking in annual gains. This is the area that I think eludes most people when they first are looking at life insurance. They don't understand it. They say, oh my God, there's a 6% rate of return was shown long-term, right? What you have to understand is, let's say that we had two accounts side by side that had 100 grand. 100 grand went into a mutual fund, and 100 grand, we were to the point where 100 grand was in the cash value life insurance. In both accounts got 10% credit. Well, they would end up with the same value, $110,000. But what goes up also comes down. So if you were in a mutual fund and it went down 10%, you were actually below where you started from. But with annual lock-in and reset, what happens with properly structured index universal life is that that principle now gets locked in. It now becomes part of the policy, never to be given back. Now, not every year is going to be 10%. Let's say it's 5%, right? But now we're 5% on an IUL from 110,000. So that's 115,500 versus 103,950. You're just above what you started from after 3 periods. That's a 9% difference. Over time, that compounding effect makes a difference. Now, that's part of the magic, but I don't think it's the real magic. Here's the real magic. It's how the reset works, right? Because everybody says, well, the market was at 940 and the bottom fell out like it did in 2000, like it did in 2008, like it did last year when we've had a flash crash. That 940 goes to 650 because there's a 0% floor in the IUL, right, or in the index universal life, that there is no giving back. That 115 gets locked, that's still 115. So when the bounce comes, they're bouncing from 650. So even though the market just barely got back to even, most of these policies have caps around 10%. This one didn't even get back to the 940, only got to 920. A 10% cap would have credited this account 120 or 27,050 on their original 100. So that's what you have to understand. That's how indexing and lock-in works. This is why IUL, properly structured, but you need time. You need to be able to build it. It needs to be able to be part of your overall plan. We have to have discretionary income or discretionary assets. We're not going to take every nickel that we have and put it into a strategy like this. This should be part of what we're doing, but not the overall solution. I have one advisor, Mark Orr is a good friend of mine. He's a CFP out of Georgia. He's an author. He just wrote this book recently. It's called Tax-Free Millionaire. And he talks about the triple play plan. If you want a copy of this and either reach out to the advisor that invited you on the call or reach out to me, I'll send you at no cost to you, a copy direct to you from Amazon. The other book that I normally will send clients is The Power of Zero. This is written by David McKnight, and it just talks about a lot of what I just shared with you here. But I really do like Mark's, the way he's written that, because he also talks about the Kaizen plan. He calls that the catapult plan, or the life bridge, which is another strategy I'm going to talk about in the next couple of weeks. So there's different things that we can be doing with assets that we've acquired. But this is a way for you to slowly start to educate yourself so you can understand how to have a tool in your overall portfolio or in your assets that you can now start to feel comfortable saying, hey, I understand it. And it really, if God forbid something were to happen, you and your family, both your income's protected. And if something were to happen to you, say medically, or you were to die, your family's wealth would be replenished. All right, so we're at the end. Hopefully I didn't bore you to death. I know life insurance, like I said, that one picture I think is pretty telltale, right? Most people get the deer in the headlight look when I go over this, but I'm passionate about this because it's the one area where there's so much misinformation. I mean, life insurance is like the only industry that tries to prevent you from upgrading what you have. It makes no sense to me. These insurance companies for years They won't disclose their costs or fees or expenses, right? So all those old contracts, if you have any old contracts, if you want to see if they can be upgraded, not every policy should be upgraded, but at least you could look at it and say, hey, I want to see what we could do to implement some of these strategies that we're talking about. Reach out to the person that invited you on the call. I want to thank everybody for being on here today. Chris Lester here, Professional Planning Services. Thank you each and every week. Stay safe. Have a great Memorial Day weekend and talk to you soon. Bye-bye.